Well, got another one for you. Cracker Barrel is in full panic mode as the latest earnings report has investors asking if this once reliable restaurant chain can survive another brutal financial hit, showing the report spells doom. You see, Cracker Barrel is about to show investors just how bad things have gotten. And analysts actually expect Cracker Barrel to just post another loss this quarter, turning what used to be steady profits into red ink. So this is coming out of Yahoo Finance this morning, where the same Cracker Barrel that once looked like a safe bet for long-term shareholders is now a warning sign for Wall Street. Now, if the numbers come back as predicted, Cracker Barrel could fall even further from the company that it used to be. So basically, analysts are predicting a 69-cent loss per share for Cracker Barrel, a reversal from profitability to red ink. So that's really bad. Last year, Cracker Barrel posted gains, and this year it's bracing for a 250% swing in the wrong direction. When the restaurant chain goes from making money to bleeding cash, something fundamental is broken. Higher costs, shrinking foot traffic, and that flat leadership has created a perfect storm. No marketing slogan or seasonal menu item can actually distract the investors from the truth of the math. You see, total quarterly sales are actually expected to land around $800 million, roughly 5% below last year's results for Cracker Barrel. Okay, so that figure says more than any executive statement. Okay, so customers are not walking in like they used to, and analysts are noticing Cracker Barrel that built their strength on consistent traffic, but the same tables are now empty more often. Now, rising grocery prices have made families rethink eating out, but that's the excuse. That's the latest excuse they're using. But at the same time, competition from cheaper chains is tightening the squeeze. And when your core customers start skipping visits, your entire business model feels the hit. Okay. So yeah, definitely they're trying to offer, some deals for Veterans Day next week and everything. But guess what? A lot of them are not even going to come through. You see, over the past month, analysts trimmed profit forecasts again, down another 2%. It may sound small, but it actually reflects shrinking confidence in Cracker Barrel. Investors actually see a management team stuck in slow motion. The analyst's tone is cautious, not confident, and that matters. Each downward revision chips away at credibility. Now, if these estimates keep falling, Cracker Barrel risks becoming just another example every finance professor uses to show how slow adaptation kills steady brands. Investors actually hate surprises, but they hate predictably bad news even more. Okay, so basically, this may be what will help Sardar Beglory to oust the CEO of Cracker Barrel and everything by using this to go ahead and get other investors on his side and stuff for the upcoming proxy vote. Okay, now at roughly $31 per share, the stock now trades near its lowest point in the year. Not long ago, the Cracker Barrel stock price hovered around $72. That's a steep slide for a company once seen as safe. People who believed in the brand's stability are watching their investments shrink by more than just half. I mean, it's not just market trends dragging it down, but it's also the inability of Cracker Barrel to convince anyone it has a roadmap out of this mess. The story has changed from resilience to retreat for Cracker Barrel, and Wall Street remembers every missed target. Okay, now the current analyst rating sits mostly at hold. In finance, hold is a polite way of saying we don't trust you, but selling might hurt us worse. Now, some price targets, stretch to about $46 per share over the next year. Yet that optimism depends on near perfect execution. For Cracker Barrel, on the other hand, to hit those numbers, well, it needs to control expenses, boost efficiency, and rebuild guest volume all at once. It's possible, but odds are not kind. You see, investors prefer proof, not promises, and this management team has not provided either of those lately. Okay, so the one carrot left is a 3% dividend for Cracker Barrel, which sounds appealing until you actually read between the lines. You see, dividends are only as good as the profits that fund them. Okay, if earnings keep collapsing, that payout actually becomes liability. You see, maintaining it drains cash, cutting it angers shareholders. Either path hurts the confidence. The board must decide whether to defend short-term loyalty or protect long-term balance sheets, which means they have to fire the CEO. A dividend from Cracker Barrel used to mean stability, and today it's just another distraction. Okay, now if you zoom out to the broader industry itself, and the picture doesn't get any friendlier. Restaurants everywhere face higher food and labor costs, but legacy chains suffer the most because, well, they're built on scale and not speed. You see, Cracker Barrel's footprint makes quick adjustments nearly impossible. And every menu tweak, every wage increase ripples through, hundreds of stores, and that's not going to get people to come back. Okay. And meanwhile, nimble competitors adapt overnight. Inflation doesn't care about nostalgia at all, but it does punish inefficiency. The companies that, survive are the ones willing to go ahead and reinvent operations fast. But what investors want to hear is the next week is a plan, not a pep talk. You see, the upcoming earnings call will be a real test. The balance sheet will actually confirm what the preview already told us: losses and lower revenue. Now, what matters is how leadership explains the path forward. Shareholders want details about cost control, menu strategy, and store performance as well. Okay. Now, honestly, this is going to be another misnomer and everything, but like I said, the balance sheet will confirm what the preview already told us, which is that the company lost a lot and there's lower revenue. But what matters is how leadership explains the path forward. Shareholders want details about, cost control, menu strategy, and even store performance metrics. In other words, will they get the original customers back in there? If executives show up with generic optimism instead of specifics and evidence, confidence will crater further. The market has no patience for, the corporate therapy sessions. All right. And this is what they're basically known for, especially CEO. Now, recent filings hit at a quiet cost cutting, renegotiated supply deals, slower expansion, and leaner staffing. But investors want more transparency. Cracker Barrel's silence on operational improvements leaves too much room for speculation. You see, if Cracker Barrel has identified ways to protect margins, well, then they need to go ahead and say so clearly. Now, when a company like Cracker Barrel underperforms for multiple quarters, communication becomes as critical as execution. You see, investors can forgive a rough season, but they won't forgive a foggy strategy. Now, from a pure value perspective, some traders see an opportunity. Buying low only works if there's real recovery potential. A rebound to $46 per share will be nice, but hope is not a hedge. Every positive forecast must be backed by new efficiency data or traffic growth. Otherwise, that upside is nothing more than just a spreadsheet fantasy, as they call it. Cracker Barrel's task isn't convincing small investors. It's convincing analysts who've stopped believing in turnaround talk. You see, market capitalization has also shrunk alongside the confidence. You see, when a company loses that much value, let's be real here, its borrowing power and leverage both weaken. You see, higher debt costs make every recovery step harder. Cracker Barrel used to operate from a position of strength, and now it's just playing defense. To restore the credibility that they lost, leadership of Cracker Barrel must show quarter-over-quarter improvement, not year-to-year comparisons. You see, investors track momentum and not memories, and the numbers right now show drag and not drive. The trend line tells the story clearly, which is erosion. Each quarter for Cracker Barrel brings slightly worse margins and slightly lower expectations. There's no dramatic crash, just constant decline. And that slow bleed can be more damaging than a single bad year because it signals complacency. Okay, so Cracker Barrel and the board must decide whether to keep trimming at the hedges or just overhaul the strategy before another cycle of disappointment hits. Now, the November 13th report will reveal whether they're awake to the danger or just hoping for luck. All right. Now, short-term traders might chase a quick rebound if losses come in lighter than predicted. But that would just be a temporary bounce, not a comeback for Cracker Barrel. You see, sustainable growth requires structural fixes, which includes pricing models, supply stability, and a better guest retention. In other words, bringing back the customers and keeping them. Unless those pillars strengthen, every rally will fade. Cracker Barrel can't afford another quarter of explaining away weak performance with economic excuses. Competitors face the same economy and are still finding ways to grow. Okay, so basically the bottom line is that Cracker Barrel stands at a financial crossroads. The market has given it one last sliver of patience, but patience runs out quickly when the performance doesn't follow. So the upcoming report is not just, another quarterly update, as many people would say. It's just a credibility test. Cracker Barrel investors want proof that Cracker Barrel still understands how to manage costs, motivate teams, and rebuild trust. Now, if that proof doesn't show up in black and white, well, the brand's reputation on Wall Street may never recover. So let me know your thoughts about this in the comments below. Be sure to smash the like button, share the video, follow our cross social media, and I'll see you all in the next one. Until then, peace.